People always say that you have to have money to make money, and that there's an extraordinary level of sacrifice on the road to success. So how is it that investors like us, who didn't start out with much money and who don't rely on banks and credit, how is it that we can increase our income and build our wealth in a way that doesn't require us replacing one full-time job with another while still enjoying the things in life that matter most to us? That has always been the big question, and this podcast reveals the answers. I am Carrie Like, and this is the Investor Warrior. Hey everybody, and welcome to the Investor Warrior podcast show. Today I have with me Tim Milazzo from StackSource, and I am saying your last name correct, right?
It depends if you're in Italy or not. In America, you absolutely are.
I was wondering if that was Italian.
Yeah, so anytime you have a double Z, you got to give it a little, like a pizza flair, like a Milazzo, but I'm not Italian enough for that.
So Milazzo, Tim Milazzo. Funny story, I worked in a clinic, went back when in my physical therapy days, and we had all these patients come over from Italy for like 6 months at a time.
Okay.
And we'd stay to do this intensive therapy. And you had Italians from the north and Italians from the south. And apparently they don't get along very well with each other. And it was a really small clinic. And so we would have like all these people in the clinic during the day, and there'd be Southerners and Northerners. And as you can imagine, it was entertaining and a little bit dramatic at sometimes.
Sometimes Italians don't even get along with like their own family members. It's pretty common. I can only imagine. So Milazzo is a city in Sicily, and the island off of South Italy. Okay. So I probably people from Northern Italy would probably instantly judge me, I'm sure.
I will have to say that my favorite patients were the Sicilians, because they were so dynamic. That's the word I'm going to use.
Expressive, maybe.
Very, very. And I swear I had a serious problem during those times with espresso, because what would happen is the patients would come in, the families would come in, and they would compete on who would make the best espresso. So I would have like 6 or 7 shots during the day.
Oh my!
You can't refuse them.
No.
And so we'd have the Northerners competing against the Southerners, and I would go home with a high, oh my God, this is an addiction. I need to stop.
Yeah. Your heart rate was probably 140.
I know. I'm like, how do these Italians do it, man? I know it was fun. So anyways, now that we've gotten past your heritage, tell us a little bit more about you and your journey into founding or into this company that you have, StackSource, because we're going to get into that. But what was your journey from where you started to where you are now?
Okay, so maybe I'll take a step further back than I usually do. My grandfather was an immigrant from Italy. He ended up being involved in real estate towards his later years in life. His family settled in New York City. He moved into New Jersey and started a family there. And he ended up owning a local building in town where he lived in Fair Lawn, New Jersey, a local commercial building. Him and his wife, my grandmother, got their real estate licenses and sold a few houses. My dad was then a leasing broker for commercial buildings in New York City. And so I had some real estate in the family history. And honestly, Carrie, I never thought I would be in real estate. So I studied finance. I interned for a big real estate company in New York City. And when I was there, I was the spreadsheet kid in the corner. I was quieter, as a 19 or 20-year-old. I was not really a salesperson. I was not gregarious like my dad as a leasing broker was, making connections with landlords and tenants and, slinging together leases in these office towers. I loved technology. I was very analytical, mathematical, and I thought the coolest thing ever would just be to work for tech companies and have perks and benefits and cool T-shirts. And so I pursued that. My first job out of college after my finance degree was with Google in advertising technology. And I was an analyst. And I kind of had a couple different jobs in sales operations, and I didn't get back to real estate for years. The reason I got back into real estate, not only is real estate awesome, and I missed that at the beginning, but because I saw the opportunity to take a technology approach and combine it with real estate. And I ended up in real estate financing, which I love talking about real estate financing, and I'm sure we will. But I kind of fused together the technology path with real estate investing.
Yeah. It always comes back to technology in one way or another in this world.
Yeah. Well, it's 2021. I love technology. I had my first smartphone in college. So the next generation, if you have a service to provide, or you're trying to raise investment, and you're talking about what's going to be in the next few years. I mean, even right now, people entering the workforce, they grew up with cell phones in their hands, or maybe they were a toddler when they had their first tablet, and that's going to have big implications in the world.
Yeah, it is crazy when I have these conversations with my kids now, who are 6 and 9, because this is all they've known. So they ask me about cell phones, and like, when did the iPhone 1 come out? And I had to like think back about when I got my first iPhone. And when you think about it, like, it wasn't really that long ago. Like, technology has just sped so quick forward.
Oh yeah.
And it's going
and it's not stopping
faster. And it's interesting to think about what life is going to be like when my kids are my age. Like, it's going to be, everything we're talking about right now is going to be irrelevant.
I think some of the same principles are applied. I wrote a blog post a while back on, I actually believe sales skills are more valuable now than they ever have been.
I see that. Yeah.
Because there's so much content out there. Anybody can reach anybody. So doing it effectively, you can actually, like, it can be even more valuable. It can be 10 times more valuable to be great at sales and relationship building. But there's probably little to no value of being mediocre at that.
Well, and you really have to stand out from the crowd now, because it is so available. Technology has made it so available to get face-to-face with people, to communicate with people, to get yourself out there into the YouTube world, and to get your brand out there, that if you're just like everyone else, you're not going to stand out. Absolutely.
Absolutely agree with that. Personal branding is huge.
Right. Yeah. So interesting. So your grandfather came over, didn't sound like he had much knowledge when he first got started. And I think that's so interesting when you talk about immigrants coming over, especially the first immigrants that came over, because my great-grandparents came over from Norway. I actually just got their trunk, like the big trunk that they brought over from Norway to Illinois.
Wow.
My mom gave me that trunk. It's, like over 100 years old. So it's sitting in my room right now. It's super cool. That's literally what they came over it. Their whole life was stuck in that trunk, and then they made it work. And it's so interesting to see like how hardworking some of these immigrant families that came over with nothing, and what they built up over the generations. Without any of this technology to help them catch up. Absolutely. Yeah. They would be lost today. They'd be like, what is all this? So tell me a little bit about StackSource and how this came about. Yeah. So I started investing a little bit in real estate, just passively as an LP. And actually, that's still my strategy today. And I'm mostly invested into this company, StackSource, and building it up at this point too. I identified, so I knew enough people in the commercial real estate world to just kind of poke my head in and ask questions. I actually went to a real estate tech meetup with a couple of friends that were real estate investors. And my eyes started getting open to this intersection of technology and real estate. And crowdfunding was just starting to become a thing, like several years ago, maybe like circa 2015. So explain crowdfunding. So crowdfunding would be some of these portals where you can passively invest in real estate online. And I think it's come a long way since then. There are some branded ones where they're like big companies that you can go in and you can invest maybe as little as $100 or $1,000, and you can become a limited partner on a real estate deal. I think there's a growing set of like real estate investors that are kind of putting up
investor portals. So if you've invested with them, you can log in and see information about the deals that you've invested in with that sponsor, with that.
So it's kind of like online syndication.
Yeah, online syndication is exactly where it's kind of going today. At the beginning, I think it was just branded crowdfunding, and is this new concept, and it actually wasn't legal to raise money for private placements online before like 2012. The Jobs Act had changed like ever since the Great Depression, when some investors were taken advantage of in the private markets. It was illegal to raise money online. It was illegal to solicit investment from people you didn't know for a private organization. You had to either go public if you wanted to raise money, like a public company. And if you were private, you had to keep it to your friends and family and people you knew, and you could not solicit investment widely. So that's changed. And that's, there was the whole Jobs Act and crowdfunding and syndication. You can do it much more broadly now. You can have a brand name and say like, hey, we're XYZ, Real Estate Investment Corp. And you can raise funds from people through a podcast. You can raise funds from people through, a crowdfunding portal would be a service that they would take a percentage of your invested capital, but they would help you market it.
Interesting. I've been thinking about using the podcast more to raise money, because we're always raising funds to put into our deals, into our single family deals, whether it's short term or long term. And so in the past, we've always just done family and friends.
Sure.
But I was actually just going to start looking into that. Like, what are the rules and regulations around with the podcast with raising money? Yeah.
Well,
so
I think
brought that up.
So I think some of these crowdfunding companies, these really, they've evolved beyond that. They've evolved to like really robust syndication platforms. Like if you went to like a CrowdStreet or a Fundrise or a Realty Mogul or Deal, there are all these crowdfunding portals, and there probably have been, a couple hundred that have launched, and there are only probably 10 or 12 that have really taken over that market. They would sell to you as a service, hey, we'll take care of some of the compliance. You need to register this with the SEC, not as a public company, but as a crowdfunding campaign. And then you can market it anywhere you want. They'll do the compliance, they'll set up, and they want a percentage of the raise, right? And they want to own a piece of it themselves or something like that. But they'll give you a platform where you can do that, where you can syndicate to your investors. And then some of them will do that just for a platform fee. They won't market it to a lot of investors for you, but if you have your own investors, listeners, followers, you can kind of, for a flat fee, syndicate to them. So, there are some of those platforms out there. That's not what our business does. That has become more popular.
Yeah. So let's talk about your business, StackSource.
So our business actually is a little bit broader, not just like syndicating to equity, but especially in commercial financing. How do you make sense of all the different lending options out there and capital provider options? So if you're buying a single family home and you're taking it out in your own name, either to live in it or, as a single family investment, if you're taking it out in your own name, it's not an LLC, you can just use a residential mortgage. You can log in to Rocket Mortgage or Better Mortgage, and you can get a rate right now, or you can talk to your local, bank or your local residential mortgage. It's exceedingly easy right now. It's 2021. You should know in less than, an hour, what the rates are, what loan you're pre-qualified for.
Yeah. I think you can get a pre-qualification letter in like an hour.
Yes, exactly. Now, if you flip into commercial, and there are a couple of reasons why you would need to flip into having a commercial mortgage. One is it's a commercial property. So it's like retail or...
Let's define that for the listeners, what a commercial property is at this point.
So it can be a retail strip center. It can be an office building or a medical office building. It can be an industrial property. Those would all be commercial properties. Actually, a multifamily with 5 or more units would be now in that commercial territory. So if you're buying a 5 unit, you can no longer use the residential mortgage. You have to use a commercial mortgage. Or if you have a portfolio of rentals that you want to roll up into one loan. So let's say you've consider
commercial.
Yeah, let's say you've been buying a few rentals for a few years and you're up to 6 or 8 or 10 units and you want to roll them into one loan. You can do that, but it would be a commercial mortgage. not a residential mortgage. And there are some key differences between a residential and commercial. And now you can't log into Rocket Mortgage. You talk to your local bank and they, your banker may literally just get confused because they don't work with those types of loans every day. They would have to probably, you probably have one or two listeners out there that have talked to their local banker that gave them a mortgage. They've said, hey, can I get a portfolio loan? And they heard the word portfolio. Oh, well, that's in business banking. And now you get into business banking and they're like, well, no, that's a mortgage thing. And your local bank may not know what to do about this.
Yeah.
The truth is you need a commercial mortgage. And now you're in commercial real estate territory. The same type of loan that would be used for this $100 million office tower in New York, you're going to need that type of loan. And there's little to no visibility about who the best lenders are, what the rates are, and they vary drastically from lender to lender.
So let's talk about the key differences between a residential lender and a commercial lender.
Sure. So with a residential mortgage, the worst thing that can happen to you financially is you lose the house. The bank takes it back. In a commercial mortgage, there can be recourse, personal recourse, meaning if you go bankrupt on that property and they take back the property and they take the collateral back and there's still a difference and you still owe the money, you're going to have to make up the difference with your personal finances. Like they can literally go collect like your checking account or like wages from your job because like you still owe them money. So that's recourse. Not all commercial mortgages have recourse. Some do. And that varies lender to lender and what the recourse provisions are. But it's a whole category that doesn't exist in residential mortgage is like personal recourse after the property. So that's one. Another thing that exists are prepayment penalties. If you get a 30-year residential mortgage and you pay it off after 2 years, that's it. That's the end of the story. You paid it off. If you get a commercial mortgage with a longer loan term and you pay it off after 2 years, you need to check what's happening in your loan documents. You may owe a penalty because the bank doesn't want you to pay it off early. They were expecting to get paid on that commercial mortgage and make the yield for a number of years, and you may owe them extra. So there's a prepayment penalty. The rates are typically a bit higher. You don't get a 30-year mortgage. The most common are 5, 7, or 10-year mortgages. You may be paying 30-year amortization, which means you're paying it as if the principal will be paid off in 30 years, but there's a balloon payment after the 5, 7, or 10. So there are some key differences structurally. And they're underwritten differently. It's more tied to the property's income rather than your personal credit score.
Right. Though they're still running credit, they're still looking at you personally as a borrower, but it's more tied to the asset itself and whether the income can support the mortgage payment.
All those things can still disqualify you. Your credit score, your payment history, like your debt to income can all still disqualify you. But just because they're good does not qualify you. What qualifies you for commercial financing is really three things. Yes, your personal finances, which we've just touched on. That's one of the three. The second one is actually your track record. Does the lender believe you are going to know what you're doing with that property? So if it's a multifamily with 5 units, or if it's, even more so if it's a local office building or something like that, do you know how to write an office? Do you know how to get an office tenant? Do you know, have you managed that type of property before? Can you convince a lender that you know what you're doing with that property is the second. And then the third would just be the property itself. Does it have income today? What would the potential income be? The property's income and what the lender believes the income will be is actually the biggest and most time that you'll spend talking about, for a commercial financing.
And then time frame with personal residential loans versus commercial loans, getting the loan, right, is going to differ.
Yeah. If you're getting bank financing for commercial, so that's where some of the lowest rates come from, are banks and credit unions, and they vary from each other, but it's typically like a 60-day, 45 to 60-day close versus it's common these days to get a 30-day close for a residential. There are certainly commercial lenders that can close in 30 days. There are even commercial lenders. We closed a loan a few months ago in 2 weeks. That is not bank financing. No bank can close in 2 weeks. That's actually a private loan. and that's a higher interest rate. We're talking about like 9-10% interest rate origination points. It can happen. But if you're talking about like this is the type of loan that I want to keep for the years to come, that's a 45 to 60 day close most commonly.
Right. Okay. So let's talk now about StackSource and how you help people with these commercial loans.
So there's all this complexity. And
Right.
if you're coming from having residential mortgages to getting into commercial financing, a lot of investors make mistakes.
Okay, so let's talk about like the common mistakes people make.
Yeah. Okay. So going to your local relationship bank and just taking whatever they give you is one mistake. The differences between your local bank and like a dozen other regional banks, like where you're buying a local property or a commercial property, will vary drastically. There's no, like, this is not as tightly regulated or as tightly kept as like a residential mortgage would be. Like, yes, you can get a little bit better of a rate or a little bit better terms, but it'll actually vary drastically. Like the leverage you can get, like one lender will give you maximum 65% leverage, meaning you need 35% down payment, versus another lender that's going to give you an 80% leverage. Like that's a very big difference in how much cash you have to come up with. The interest rates will vary. The loan terms will vary. Everything else we talked about, recourse, prepayment penalties, all these things can vary from loan to loan. So there's so many differences between the loans. And so one common mistake is just going to your local bank. They give you a term sheet, signing that, depositing, and there's a bigger opportunity in commercial to miss widely on like better financing that you could have had.
So to counter that mistake, go to various different banks, get their different terms. And I'm assuming that if terms vary so widely, they can also be negotiated.
Very negotiable.
In the commercial world, which is not the case in the residential world. The rate is what the rate is in the residential world.
Yeah. Go ahead and try to call Rocket Mortgage and say, I don't like your rate. Give me a lower rate. You're not going to get very far. In commercial, you're leaving money on the table every time you take a term sheet at face value. So it's about shopping multiple lenders for sure. And it's about negotiating the relevant points. Now, again, it's not just call the banker and say, I want a lower rate or I'm not working with. Sometimes that may work because actually they do have some variability. There is some spread built in, but understanding like what's negotiable on the term sheet. Okay, I'm going to have a higher rate if it's non-recourse, but I really want it to be non-recourse. I don't want to put my own personal finances on the line. Like, so negotiating, hey, I want this to be non-recourse, but for 10 bips, there are so many different things that are negotiable on the term sheet, but you need to figure out what's market.
Right.
And that means getting quotes from multiple lenders.
Right. Okay. What's another mistake?
Another mistake would be not understanding the credit committee approval process. So again, you've got a term sheet from your local bank or from any lender that's given you a term sheet. It is not a pre-approval. So there's a very big difference between I'm pre-approved for a mortgage, and as long as something doesn't come up in due diligence, I get that loan. Some of the worst things that happen in commercial finance, and what some of the biggest things that we're addressing with our platform, is you get a term sheet from your banker, you go under contract on that building, and your due diligence period like passes. Now your deposit is hard. Like if you don't close on this, like the seller is keeping your deposit, and then you hear, sorry, your loan has been declined by the bank. What does that mean? You told me you were going to give me this loan. I did a term sheet. I did a deposit. An appraiser came. Like, what do you mean it was declined? And that's because the loan officer you deal with is not the ultimate decision maker for whether that loan gets approved and funded.
Right.
And
it's the other.
That's mind blowing for the first time somebody gets screwed over by a lender. And if you're in commercial real estate long enough without like knowing these things, it probably will happen.
But here's the problem with the whole loan approval process is a lot of times by the time you get past the appraisal, you get past the due diligence period, the underwriter looks at everything. At that point, they tell you whether it's going to be approved or denied. And at that point, you are usually past whatever period
Yes.
Is part of that due diligence period.
Yes. There are ways to figure out upfront though, here are the risks that we should talk about right up front while there's still time to change lenders and understand who the decision makers are with that lending institution. So at any bank or credit union, it's never going to be the loan officer, because the loan officer is paid for loan production. So now they can't even have a say whether that gets approved. It's going to be a committee of people, usually a chief lending officer, sometimes the bank CEO if it's a small one, there's always a credit committee. Understanding what that credit committee is looking for and why they may decline a loan, and knowing that up front and finding that out faster is the way to mitigate that risk.
What are some of the reasons someone would get denied for a loan? What are some of the most basic, most common reasons that someone's going to get denied for a commercial loan?
So I'll say the most common ones are going to be problems with the underwriting of the property. Like if you're underwriting, this property is going to generate this much income, and then the property, like through sourcing comps, through applying like the correct market vacancy factor, like just mistakes in underwriting, if they're not caught by the loan officer, but then like a credit analyst is saying, this is not going to generate 200,000 in income. Like they underwrote no vacancy. So mistakes in underwriting that are not caught by a loan officer are like very common. Like that you may get your loan denied. You may also just get it retraded. So, hey, we said we're going to do 75% of the purchase price, but we found out this in the underwriting and a credit analyst re-underwrote it. And like, actually we can only give you 70. Now your loan's not denied, but like it's different than what you were expecting it to be.
Right. Okay. So ways to counter that. Be conservative with your numbers.
Well, having an advocate that like is an expert with that type of property, like that knows how to underwrite multifamily in a way that like is going to pass credit committee, is something that shouldn't be taken for granted. Actually, if it's a portfolio of rental properties, for instance, understanding like comps in the market and like what market rent is, not just your own finances, is like something that's an important piece that a credit committee will scrutinize. But then honestly, sometimes with less than stellar lending institutions, you can do everything right. And the problem is you have a bad lender because they didn't tell you up front and the loan officer didn't even think to check. They're full on originations for that year for that property type, or they can't, it literally can be as bad as that lender has decided not to make any more of those loans just because they've given you a term sheet. Again, it's not a pre-approval and they don't have to make the loan. The loan commitment comes later after the committee.
Right. Got it. Okay. So let's get back to StackSource again. So why did you start StackSource and what is it?
Okay, so StackSource is a commercial financing portal. What we've done to try to combat these common problems in the commercial financing world, not knowing who your options are, not being able to find the lenders that are most competitive, not being screwed over by a lender at the closing table. We've built a platform that has aggregated commercial lenders across the country. At this point, we have more than 700 lenders in our network. And we're able to match deals to the right lenders that are both reliable and going to be able to quote and give you the best rate and terms on the loan. And so you visit StackSource, you give us you give us information about that deal that you're working on, whether it's a refinance of a portfolio or it's an acquisition of a new property. You get instantly matched to the best lenders for that scenario. That's going to depend on the asset type, the location, the loan size. It's actually 70 different criteria that will determine whether that lender is a match or not. And then the lenders that are matched are going to compete for your loan and give you competitive quotes. And so this replaces the process of trying to get to know 20 different banks for your deal. We already know those lenders. We know the banks, the credit unions, Fannie Mae, Freddie Mac underwriting standards and how those are different, at this month versus that one, commercial mortgage-backed securities. There's all these different types of loans that can potentially, provide the mortgage for a commercial property. And we show you competitive quotes from each of the financing options and then work with you through a capital advisor to make sure that that loan is going through.
You're like Match.com for borrowers and commercial lenders.
Yeah, except the lenders can't actually reach out to the borrower directly. Like we don't like, we make sure that you have one point of contact where it's not like, oh no, like now I have 17 different lenders reaching out and like sending me like weird DMs, and there's definitely no weird pictures being sent over.
Right. No swipe up, swipe down, left, right. I don't know. So what goes into matching someone to a lender? What are some factors that go into that?
Sure. The leverage request. So if you're saying, well, I need 80%, I can only put 20% down, you're going to eliminate a bunch of lenders that might have lower rates, but can only do 70 or 75% of the purchase price. Like that's really common. So the leverage, the exact like zip code and address of the property, and like whether that lender can like lend there and whether they're going to be competitive in that area, the asset class, back down to like really nitty gritty stuff like the ratio of the borrower's net worth to the loan amount is like something that many lenders care about. The total liquidity that's projected for that borrower after closing, some of the borrower financials. It literally goes out to like 70 different like yes, no, does this lender match algorithmically? But like it's really all about that same stuff: the property, the financial scenario, and the borrower. And all of those things, we either look up the data in the background when you give us the property address, or we ask you, hey, provide us with this piece of information. That's going to go into whether or not you're matched to certain lenders.
What do borrowers need to think about before contacting you? Let's say I don't even have a property, but I've got my eye on a few things. What are some things that I need to keep in mind when it comes to me, the borrower, like my liquidity, my credit score? You talked a little bit about track record, but what is it that I need to keep in mind before I even start the process? Okay,
so there's some general rules about commercial financing. You're never getting like a 10% down like you might be able to with a residential mortgage. It's always at least 20% in equity. And then there are benchmarks depending on the type of deal you're working on. Multifamily, pretty common to have 75% or 80% leverage. Other asset types like a retail, you'd be lucky to get more than 65% leverage. You're probably having to come with 35% down. So there are some, getting to know some of like the generalities is important. Like an intro call with the StackSource capital advisor that lasts like 20 minutes talking about investment strategy and like what financing strategies might be a fit. Like that's something that we do all the time. Just talking about the state, like where are the capital markets today in the middle of 2021? Like, we're kind of recovering from COVID, like where is financing right now? Like that's something that you should have in the back of your mind as you're shopping. Then there's, do the property's numbers work?
Right.
And that can be an intense process, like especially if you're looking at deal after deal after deal and like running the underwriting. So what we did there is we actually built a free tool. You do not need to use StackSource for financing. You don't need to tell us everything about your deal, but we actually built a browser extension tool. So if you're using Google Chrome and you're visiting different commercial property listings, you could click the little StackSource logo that would be added to your browser, and a commercial financing calculator would appear over the page. In some cases, it would scrape information right off the page, like the zip code of the building and the current income of the property and the listing price. You can change all of the assumptions. You can say, okay, well, what if I bought it at this lower price? And then you can select financing options that would be appropriate based on the size and the asset and the location. And it will calculate the best potential financing for you in real time. So that's something that we built because that's not an easy thing. Like you don't want to have a 20-minute call with a capital advisor every time you look at a listing. That's not possible. It's not hours in the day. And nor do you really want to spend an hour building an Excel model about every, house or multifamily or commercial property you're looking at. So we built this as like a quick calculator to say, here's the maximum financing you can get, or here's the likely financing that you'll qualify for on a property by property. And you can do it really quickly.
Yeah. So we have a similar spreadsheet. I know you and I had spoke before this recording, but my husband over the years had built this like super intense, very intricate spreadsheet when it comes to multifamily. And he can now, and I don't mess with it because like spreadsheets, they just, I don't know, they kind of bog me down, but he's like the spreadsheet king. Yes. And so, he'll just plug and play. He'll take a deal, he'll put it all in there. and he can analyze it in like half an hour, usually, maybe even less. But for most people, like the spreadsheet that we've built it would take us like an hour just to go like through it with them, and they would probably get really confused with it. So I'm guessing yours is a little bit simpler.
Ours is even simpler than your husband's. As a matter of fact, ours would be like the 90-second check to see if the half-hour underwriting is even worth it. It's like, man, on this property, I couldn't get, with the current cash flow, if I wanted to finance it with the bank, I'm not even going to get more than 65% leverage because of the cap rate. Like it'd literally be like spend 60 or 90 seconds on the page, whip open the calculator. Is it even an interesting deal? Like, let's put in some assumptions. Oh, it's like a 7% cash on cash return. Worth diving deeper. Then do the half hour of spreadsheeting. Like this is the idea, is like within that half an hour, let's look at 12 or 15 properties and then decide the 2 or 3 that I want to really spend time with. That's really what our tool, it will not. And then you can't rely on that as like oh man, like this is a great deal. No, you need to underwrite it. You need to research. Ours would be really the quick check before even doing the spreadsheet.
Right. Okay. Let's talk about like some of the gotchas with commercial lending, because I know the gotchas in residential. What are some of the gotchas in real estate, in commercial lending when you're getting a loan for commercial building?
Okay. So a couple of gotchas. Amortization is not the same as loan term. So if a lender says, hey, I'm going to give you 4% and 30-year amortization, you need to look at the actual loan term, because that means you have to pay off the loan after 5 or 7 or 10 years. It means you either need to refinance or sell the property at that time. You can't hold a commercial property without refinancing for 30 years. So that's one gotcha. Another one would be really looking in your term sheet to see like what the prepayment penalties are, and does that match with your business plan. If you have a big value add deal and there's like heavy prepayment penalties in like years 1 through 5 on that loan, like that even if it's a low rate, it does not match your deal. You may just want to use a bridge loan with no prepayment penalty and then get the permanent loan after adding value. That's another gotcha. Those are a couple. There are so many. There are 100 ways a commercial financing can fail. And so I will say the last gotcha is, if you are new to commercial financing, trying to do it all yourself without somebody on your team that knows like 80 more gotchas. Yeah.
And so that's where your advisors come in.
Yeah. Well, either you have an equity partner that's done this 20 times. That's great. If not, a commercial mortgage broker has probably done this 100 times. StackSource's capital advisors have done this 100 times. We happen to be more transparent and like a lot faster than brokers that don't have our tech, but like good commercial mortgage brokers are going to do that for you too. If you don't have some equity partner that like is walking through every step of the deal with you and like pointing these out, forget about trying to be the hero on everything for a second. Partner up with somebody that's going to like help you avoid 80 other gotchas, honestly.
Someone's asking, what if you as the borrower would always like to put down 50%? Would that increase your chances of matching with a lender?
Absolutely. There are tons of lenders that would love to make more conservative loans, and they'll give you a lower rate to do it. It'll depend a little bit. If we're talking about on a portfolio, we're probably looking at like an interest rate in the 3s, 25 or 30-year amortization at that point, and like a 10-year term. If you're talking about a multifamily property and leveraging it at 50% and there's really good cash flow and you have a really great track record, now you're into like the very, very best interest rates you can possibly get from life insurance companies. Yes, life insurance companies. You're not even talking to a banker at that point. As a matter of fact, you're never going to find the right person at the life insurance company. You cannot go down the road to like the person that's trying to sell you life insurance. That's not what I'm talking about. Life insurance companies are sitting on so much money, and they do not like making risk, but they're sitting on the money they haven't paid out in policies yet. And they do not like taking big risks, but they love 50% commercial real estate loans. And they're going to give you a rate at like 2.7% and 30-year amortization to do it. Heavy prepayment penalties. They don't want you paying this off early. They want you sitting on the property for a long time. So they're going to give you a 15-year term, 30-year amortization, rate in the twos today, just like a residential mortgage would be, because they love conservative real estate loans. So that was actually interesting. That would be something, if that listener actually has a 50% loan, don't even go to a bank. You can actually do even better. That's like the golden ticket to the lowest interest rates.
Yeah. Okay. What about buildings that need repairs, that need work?
Yes. Certain banks and credit unions will make loans on those types of buildings. But if you're trying to maximize your return on investment, the common strategy is to use a more expensive loan, like a 9 or 10% loan. Why? Or 7 or 8%. The reason is private lenders, for a year or two, they don't want their money out there for a long time, but for a year or two, they'll give you money at, say, an 8% interest only loan. You go ahead and make those major repairs. You make major upgrades to the property. Let's say you did a great job and now the property's worth 40% less. There's no prepayment penalty. And now you refinance and you take all of your cash out of the deal. You get monthly cash flow and now you have a 3.5% interest rate. And your return on investment is higher than if you took the bank loan right away and you're stuck with it, because you get to refinance quickly as soon as you add the value. So it's actually like one of these scenarios where you want to forget about the interest rate for a minute. Take the 8% loan, take the 9% loan, because it's more flexible and because they'll give you higher leverage and you can refinance. And that's actually maximizes, like, there's a couple of ways to look at your investment returns. There's like cash on cash return, there's IRR. It actually maximizes both of them to do that way.
So you have both short-term lenders and long-term lenders then?
Yes. Yeah. And this is where a conversation may come in about like, hey, what are you doing with this property? Like, what is your business plan? Mm-hmm. And if your business plan is like, well, I'm tearing it down to the studs and like, redoing everything. Let's talk about short-term financing in a way that's going to, like, in year 3, give you like much, much higher investment returns.
Yeah. Okay, great. Gosh, what are my other questions? What are some of the fees that you need to look out for with commercial lending?
There's usually going to be origination fees. I'll go here with you, Carrie. In commercial lending territory, there's no Consumer Protection Act. And in residential mortgages, lenders are required to disclose every fee, and so are brokers. Commercial lenders, strangely, are not required to disclose every fee that goes on behind the scenes. So that means there can be behind the scenes. So if you're with a less scrupulous broker or a lender, there may be fees behind the scenes that are making your loan more expensive. You won't see them, but it'll end up in a higher rate when the rate could have been lower. And it literally was at the discretion of the broker or the lender to make it so. StackSource, like, our core value is transparency. So we will never, for any borrower of any size, make the loan more expensive so that we make more money. But it is legal and it's common in commercial lending, and it sucks. So
basically you're saying in the commercial world, you can find out about the fees at closing. Or never, because they're hidden. It's like a hidden fee.
So let's say you have a broker, you have a financing broker, and they say, I'll go get you good financing on this and I'll help you towards closing. And again, there are good ones and honest ones. But what they can do is they go source a bunch of quotes from banks, and they got 5 different quotes back. One of the banks is like, listen, we really want this loan. We really want this property. I'm going to pay you 0.5 point under the table after close or at close. And it can literally happen at close and not be on the closing statement, and the borrower never sees it. It's like this terrible, like, it's legal, and it's literally not all that uncommon. And then the broker literally never shows you the lower interest rate quote because he wants you to take that bank that pays him extra. It's terrible. It's awful. It's something that if you work with a broker that's not StackSource, StackSource will never do this. But if you work with a broker that's not StackSource, you should negotiate the fee agreement to say that they can't take a yield spread premium. That would be the term, is a yield spread premium, meaning they agree with the lender to juice the rate so that they take an extra fee. I would write it right into the contract that they are not allowed to take a yield spread premium and that they have a fiduciary duty to you because it's not given and you may never find out about it otherwise.
That's a good golden little nugget because that could save you a lot.
It's one of these things that I discovered before we ever built StackSource. It's one of these things I learned about the industry by talking to enough people and asking enough questions to find out that this was a thing. And that was one of the reasons that lit a fire under us to build this platform with the core value of transparency, because I found out that the majority of real estate investors didn't even know about this.
Yeah.
And it was not uncommon. And like, that is one of the biggest reasons we built this.
I think that most real estate investors who primarily deal in single family wouldn't know about this because that's not part of the single family world.
It's illegal in the single family world.
Right. It's interesting. I wonder why it's regulated in the single family, but not in the commercial world.
If you're a real estate investor, you may not be the most popular person with politicians, to be honest. Like, there's a whole like movement in like certain states and federally, like, you know, landlords are like
recently. Oh
my goodness. Like, you know,
not to get into politics, but
no. And let's not get into like all the nitty gritty of like rent control, but like our country is trending more towards like tenant advocacy in a way that like can leave landlords behind. Yeah. And you're not going to find a whole lot of protections for being like, if you're doing commercial deals, you're kind of viewed as this rich investor that like needs to fend for themselves versus if you're buying a home and now residential mortgage is like, let's protect grandma, Consumer Protection Act, and like nobody screw her over. But if you're in the commercial mortgage world, you're kind of on your own. You may even be viewed as like, oh, good, somebody's screwing them over.
Yeah, someone wrote business versus civilian world. You're in the trenches when you're in the commercial world. You got to fight. You got to fend for yourself.
Oh, absolutely.
Yeah, which is why it's important to either have someone in the deal that's got experience or have advisors on your side who are looking out for your best interests.
Working with people that you can trust is like, you know, that should have been the one thing that I stated is like, you know, what can go wrong on a commercial. Like, it's like you have to work with people that are trustworthy. Like, that is the biggest mistake that you make is you end up working with someone that's untrustworthy and you can lose a lot of money.
So would you consider yourself like a fiduciary in the commercial lending world?
So while I'm not sure if like an accountant or lawyer would say that the term like would legally apply, we absolutely think that way. So if anybody's wondering,
like your core values are,
So we have our core values on like the About Us page on our website. Number one is transparency. You can also see what all of our capital advisors agree to. If you went to the URL code.stacksource.com, it's gonna pop up with a document that's like public and accessible. It's the StackSource Capital Advisor Code. Like, you know, it's kind of something that they have to sign on their first day working at StackSource, and like they're redirected to every year to be reminded. This is the way we treat borrowers. One of the tenets of that is we don't do favors for our lending partners. We do business with our lending partners. Mm-hmm. That means we're not giving some lender or pushing a borrower towards some lender because we're trying to do them a favor or because they're paying us. No favors between StackSource and lenders is like a rule written in like, you know, it's technically written on a digital document, but I like to think of it as written on like the stone tablet of the StackSource Code of Conduct.
Yeah, very cool. All right. I guess my last question would be, so most of our listeners, I think, are probably in single family, but have an interest in getting into multifamily and commercial if they haven't already dabbled in it.
Yes.
So for someone who has a track record in single family, but is just starting out in commercial, what is some advice that you can give them?
Okay, so the underwriting of a multifamily property is like really important. Comps for residential are really just sales comp based. There are 2 or 3 different types of comps that matter for multifamily. Rent comps become extremely important, and they're important in rental. Like, you need to know how much income there's going to be, but the property, like the loan, is actually going to be underwritten based on not just sales comps, but rent comps. The appraiser is going to gather rent comps. That's going to be something that can potentially limit your loan proceeds. So rather than waiting for some credit committee member to review an appraiser and say the rent comps are too low, do it first. Do the 2-minute underwriting to see, is this deal interesting? Then do the spreadsheet underwriting to say, does the numbers work? As soon as you're done with that, rent comps. Go look up what are comparable properties. Again, whether it's 10 single families that you're rolling up into one loan or it's one multifamily property with like 5 or 10 or 20 units, look at rent comps early and look at them often, because it's something that is key, not just the sales comps of like a per unit value, but you need to know like, what are these things renting at? Because that is going to matter to the appraiser and the lender. And it's something that can mess up your deal later if you don't do it.
I have an interesting question. What if I've got 10 single family homes that all need work and I want to flip them?
Yes. So we just did a loan in Texas of, I think it was 8 or 10 single family units. And somebody had bought them out of a bankruptcy auction.
Okay.
And they all needed work and they weren't fully, stabilized.
Yep.
So stabilized would be the property's ready and they're all rented at full rent. So it wasn't stabilized yet. And we lined up a private lender, again, 8% capital. I would not rush to the bank loan. You can still get like a 4% bank loan on a portfolio like that. But then you're locking into that loan. I would get an 8% loan. I would fix them. And then I would refinance at like a higher value and take your cash out, because now you can buy more properties.
It's pretty good, 8% for a short term.
Yeah, and it's like interest only. You're not paying any principal, and it's completely flexible. It's at a higher leverage where like there can be reserves that would be released upon like value being added to the properties, and those things now achieving that higher value. There can be a reserve account for that, and it's going to close much more quickly too. Now you can close within 30 days, so you're not holding up the deal, and there's not all this extra 45, 60 days for the bank.
Is there I keep coming up with questions. Is there a minimum loan amount for most of these lenders?
Yes, every lender is going to have their own minimum and maximum. So you're going to, like on the StackSource platform, you're going to match to very different lenders. If you put in a $500,000 loan request versus a $50 million loan request, and you do loans like in both of those ranges. But you're going to be matched with different lenders, and you may actually be matched with a different StackSource capital advisor that actually specializes in small balance if you're in that category. At a certain point, a loan is too small. If you're trying to get $100,000 commercial mortgage, that's going to be like the hardest thing ever. And we're probably going to tell you, listen, you shouldn't work with StackSource there, because we have some minimum revenue that we need to hit for each deal for it to be like even worth our effort. And we're probably going to charge you like 7% origination fee. And that don't work with us on 100,000. We've done loans as small as $250,000. But if you're under $400,000 or $500,000, you probably don't benefit from us getting you a better rate in terms. We're still going to get you a better rate in terms, but now you're going to pay us to do it, and it probably doesn't benefit you. Like we start to be helpful at like the $500,000 threshold.
And are you able to finance commercial land?
Our biggest loan, and I don't even think I told you this, our biggest loan this quarter was a $33 million land development financing. What is really hard is if somebody says, well, I'm just sitting on vacant land and I don't plan on doing anything with it. Nobody really likes that. Nobody likes that story. Nobody so, where's that? That's not a good story. This story was, there's a land developer, it's raw land, but they pre-sold lots to a national home builder. And for that home builder, what they're going to do is they're going to put in the roads and the pipes, and then do the subdivisions, and like they're going to develop the lots that then the homes can be built on. That's a great business plan. That's a great story. We know that the loan's going to be taken out in 24 to 36 months. And we know that the national home builder, so that was our largest loan this quarter. And, we had $33 million of financing for that. If you're just like, I own this plot of land and I'm not doing anything with it, don't expect to get more than 50% leverage, because like nobody likes that story.
Yeah. Interesting. Okay. And then Maria has a question. How does personal credit work? I guess what's the minimum credit score for most of these lenders? Yeah.
Well, if you want to get like Fannie Mae or Freddie Mac multifamily financing, which does exist, it goes up to 80% leverage. It has decent rates, not as good rates as some of the best banks and credit unions, but it's non-recourse, and it's very, very popular for that reason. You do need a 680 credit score. Banks will have their own requirements for minimum credit score. It's usually somewhere in the 600s. If you're in the low 600s, or if you have some credit history challenges at the moment and you're in the high 5, there are lending options for you. Make that the first thing you disclose. here's where my credit score is and why. Here's, maybe I had a bankruptcy, maybe I didn't, maybe I have, some challenges on the other side and some family stuff happened. Just disclose that right up front. There are lending options for you. The property needs to make sense and your track record needs to make sense, because you're really not bringing much in that third bucket of like personal finances, credit. So make the other two buckets strong. Hey, I'm going to disclose this right up front, and here's why the deal is strong. There's options for you. A little more expensive, probably interest rate closer to 5% rather than 3% on bank deals, but absolutely can get done.
And with borrowers who don't have great credit, maybe don't have a huge track record, but they've got this amazing deal, what do you usually see happen in those instances?
That's a really tough gray area. I would say you probably need partners.
Yeah.
Like, probably don't try to take down that deal alone. Like, the deal's great. Partner with somebody that can like get all the equity lined up, can like help you qualify for a better loan. You probably need a partner in that scenario.
Yeah. Okay. Great. Well, this was all good information, Tim. How can people get a hold of you if they have more questions, and how can they, you talked about the tool, the browser extension.
Oh,
how
sure. The browser extension is free for anyone to use. You don't even need to log in and tell us who you are. You go to stacksource.com. You'll find my contact info there. Scroll to the bottom, or I think at both the top and the bottom of the page, there will be links to our browser extension. You have to be using Google Chrome. That is the only browser that it works for right now. You can't be using like Safari, so you just have to be using Chrome for that, or Firefox doesn't work. I am active on LinkedIn, Facebook, Twitter. Tim Milazzo, if you search it, I will almost always come up first on those social platforms. If you Google Tim Milazzo, if you Google StackSource, I'm coming up. But here's my personal email address at the company is Tim, Tim at stacksource.com. That gets to me as well.
Okay, very good. I don't see any other questions. So thanks so much, Tim. This was great information.
Yeah, absolutely. Carrie, thank you so much for having me. And thank you for educating your real estate investor base with the steady stream of content, and keep up the good work on it.
I always end up learning some things myself on these. So thank you. All right, you guys, that's it for today. We'll see you on the next episode. And remember, you are only one deal away. Take care, and we'll see you soon.